In Part 2 on Lesson 1, we discussed how to look at the S&P 500 using market internals. This can give insight into what's going to happen next. The index by itself doesn't really tell you much about the overall situation in the markets. In this video, I'm going to show you another way to look at the market internals and then explain how the large traders use the index to cloak their next moves. Here is the chart from the last video showing the S&P 500 compared to the number of stocks in the index above their 200-day moving average. As you can see, the S&P 500 has been trending upwards, but something took place in late August that sends up a red flag. At this point, the number of stocks in the S&P 500 above their 200-day moving average began to drop. It has now dropped from a high of 82% to 64%. So how has the index continued to make new highs in the number of stocks above their 200-day moving average going down? How can the big traders do this? Let's go back to our lesson on the composition of the index itself. The index components are weighted based on their size. The large traders can use this knowledge to cover up their next moves. We will call this group the Tier 1 stocks. These 56 stocks carry 1/2 the weight of the index. Selling pressure makes a stock go down. So if there's no selling pressure on this tier of stocks, the index will most likely not go down. So here is what they do. They keep the buying pressure on this tier of stocks while they sell the other 400 plus stocks in the lower half. Even with all the selling in the bottom group, the S&P index will stay steady or even go up. Once they have repositioned all of their lower tiered stocks and they are ready to move the market down, they start selling top tiered stocks. This is the reason the markets usually fall quickly from a top. They all know that the first guy out makes the most. With this concept, they keep the markets moving up. The news media is reporting higher highs, and the retail people, you, are getting the animal instinct to get in. They're going to need somebody to distribute their stock to. I keep up with this activity by using a relative strength chart. I look at the S&P 500 equal weighted index divided by the cap weighted index. In the equal weighted index, each stock carries 1/500th of the index value, so this index gives you more information about all the participants in the S&P 500. In this chart, you see the peak in December and has been going down since then. You can also see that this chart goes down ahead of the cap weighted index. This is not a surefire indication that the major indexes are going down, but you get a clearer picture of what is going on. This activity suggests that you use caution going forward. In our next session, we will look at the put-call ratio. If you want to learn more, you need to like my page and follow it. You don't want to miss anything. Until then, this is Doc saying stay hedged.